and whether it means it is once again time for stocks to surge. Let's ask Ed Yardeni. He is the president of Yardeni Research, and he is with us, as you see, at Post 9. I mean, nice to see you. It's a noise versus reality market. It continues to be. You're smiling because, I mean, we've seen this movie so many times before. We try and fall for it, and then here we are. What's your view?
Well, my view is that the economy has been remarkably resilient through thick and thin. It's been hit by all sorts of shocks, really since the beginning of the decade. Last year we had the tariffs, and we had remarkably strong second, third, and now probably fourth quarter real GDP numbers. And as a result of the resilience of the economy, guess what? Earnings are extremely resilient. So I think we've got a earnings-led melt-up in the stock market. Earnings are melting up, so the market's melting up.
I mean, I think you lay out the reason why people say ignore all of the noise, and bluster is not policy.
Correct.
And focus on the prize. And the prize is exactly what you lay out, as did David Solomon this morning with Squawk Box. Listen to what he said. All right, well, I'm going to tell you what he said. I will. He said, I think we're set up where we have the possibility for a stronger growth trajectory for the next few years. May not happen, but certainly that's what people are betting on, right?
Well, Scott, I hate to push my brand here, but I've been talking about the roaring 2020s since August of 2020, and it's been working pretty well. I mean, we're 6 years now into the decade, and the stock market's at an all-time record high, GDP all-time record high, and so all we got to do is what's going to happen in the next 4 years, and I think it's a reasonable bet that the economy does not have a recession. If it doesn't have a recession, then PEs stay here, and it'll be earnings-driven.
What about the idea that, you know, if nothing else, the erratic policy making is just going to lead to more volatility? It may not lead to a big and prolonged drawdown, as we keep witnessing, but it may, at the very least, the minimum, just increase volatility.
Well, I think the market's kind of getting used to it, right? I mean, last year, the volatility to the downside was pretty terrible as we got towards Liberation Day. And then, a few days later, we saw the president moderate his views, and the market went straight up. I've observed that geopolitical crises are very often buying opportunities, and it looks like everybody else knows that because they all jumped on the geopolitical crisis we had on Tuesday with Greenland, and by Wednesday it was so what?
Yeah, but it was more than geopolitical. It becomes with the tariffs, then it becomes potentially economic again. And we don't want to have to get our pads and our calculators out again to try and figure out what additional and increased tariffs are going to mean for GDP here, there, and everywhere else.
On Tuesday, we could have had a really bizarre situation where the president was talking about 10% tariffs additionally on Europe, and the Supreme Court, we were all waiting for them to rule, and they might have ruled that they're not constitutional. Now I think we have to wait until February to get the results from them. But look, this is the art of the deal. It's very noisy, it's very loud, it's full of bullying, and at the end of the day, deals are done.
Right now we have a framework.
Exactly.
Maybe we'll learn what exactly the framework is coming up. Maybe
but as long as it doesn't really affect the U.S. economy.
Well, that's the bottom line.
Yeah, that's the bottom line.
Well, that's why the market has reacted the way it has the last couple of days.
But it's not just the bottom line. I think the economy itself is demonstrated as like, make my day, hit me. And we've been hitting the economy with all sorts of shocks since the pandemic, and the economy just keeps moving along. Consumers spend and businesses spend.